all series we have investment there. And we have also enjoyed the fruit of it's giving 30%, 35% kind of a return. But if you look at it, last few months, last few couple of months, continuously, maybe 14, 15 months, it's been dragging and it is continuously giving an incremental negative return. And some of the portfolios are in negative return. So thereby there is an anxiety, concern coming out of the
Right.
clients community. And when is it expected to revive? All those things is what bothering all of us. And
Right.
the question which they ask is, should I exit? Should I hold? Should I add more? Should I switch? So
Right.
these are a couple of things which keeps coming in and bothering us. So we thought we will hear it from the horse's mouth. So from you to understand what is the perspective, how it is expected to revive, how long should that process takes, and what is there any strategic difference you have brought into this, or anything which we should know about this is what we wanted to get a first-hand information from you. And we will ask a couple of questions which has come from clients at the end of the session. Hope
Sure.
that is fine with you.
Yeah, yeah, absolutely, absolutely.
Yeah.
Yeah.
So once again, thank you for joining that too on a
No,
Saturday.
no, not
All
at
right.
all. I
Yeah.
think this got pushed by a day. You're
Yeah.
supposed to do it earlier, and then a colleague of mine had fallen ill. I was
Yeah.
supposed to do it earlier, then I wasn't there. So then, I had asked a colleague, a product guy, but then again, he was not available because of a throat infection. So my apologies that, we postponed it. And very quickly, I want to thank all the investors for, being invested with us. Again, I always tell investors that investment is a marathon, not a sprint run. So I don't foresee, or our firm does not foresee, at our end, that there has been anything wrong, in the founder strategy. You've seen the fruits of the strategy really doing great earlier. Okay, right now in the last say 14 to 15 months, in certain periods we've had underperformance. Again, was it because of something bought, or something fundamentally wrong done by us? Personally, if you ask us, we believe that no, there has been nothing wrong in the way we manage money. It's just that the style of investment that we guys follow, which is growth, style and quality, it has been under some underperformance because of a lot of global events or news which have basically happened. So what I'll do is I'll quickly just share with you that what I'm just skipping all these slides. I'm just going straight away. Yeah, yeah. So this is the market for you last 1 year. If you look, so honestly, if you ask me, last 1 year in the market, I'll just nothing much has changed. We've been talking about strong earnings growth. So if you look at this is your Nifty, the large cap. These are your mid and small cap earnings growth. So right now, consistently, your small and mid cap earnings growth have been consistent. So there's been no downturn in terms of earnings on the mid and small cap side. Okay. In fact, if you look at from the large cap side, the earnings have been flattish, and they continue with the trend of the last 4 years, where large caps, earnings have been, thoda sa, I would say, muted compared to your mid and small cap. But when you look at the price performance, so despite markets not, the Nifty not having strong earnings growth, still the price appreciation happened. Whereas the folks which had strong earnings growth, their price appreciation did not happen. So, it was just against the fundamental, rule of financial investments that, prices are slaves to earnings. What we've noticed is that despite strong earnings, the price has not gone in. Now, what that has basically led to is that from a mid and small cap perspective, valuations have become, far more reasonable compared to what they were 1 year back. So if you look at a mid and small cap indices, which was at say 43 PE in December 2024, as of December ending, it's close to 31, 32. Okay. Same is with small cap from a 35 PE, it has come off to around close to 28, as of yesterday. And if you look at Nifty 50 from a 21 PE, it is close to 23. So it has only become expensive. Even when you look at from price to book valuations, mid and small cap actually are available to you at a reasonable price. Now, what this slide basically tells you is that this is the behavior of the market. At times, what happens is because of a lot of noise in the short run, and where the fear psychosis basically hits, a lot of investors' behavior starts changing from the normal. And typically, this was a time where if you remember in Jan 2025, Trump came to the government of presidency. Immediately, the tariff talk started off, and if you remember when he came into the, in that quarter of Jan, March, okay, you immediately saw tariffs being levied across the world. You saw 20% fall in the Indian equity markets, right? Nifty hit. And then after that, there was some amount of recovery. And today we are again going through a patch where again some noise has started to basically hinder. That fear psychosis, or I will say the noise has not subdued in the last 14 to 15 months. And what that has basically led to is that from a client perspective, clients are saying, boss, for me, earnings is not important. For me, safeguarding my capital is more important. And the tilt has been that people have started to move more towards your, the larger cap on the equity side, or they've been more towards, gold and silver, the way they basically it has ran up. But will that make mid and small cap a bad, a place to be invested? I think this is the period when, nobody wants to touch equities. If the earnings growth is great, then the rule of the law has to basically prevail, the fundamental principles of investing. The price will have to catch up with the earnings. And that's the reason when you look at valuations, we believe mid and small cap have gone into a zone where honestly there's been a unnecessary correction. And this is the time where you can do some top ups, because you're getting those same mid and small caps at a fairly reasonable valuations compared to what they were 1 year back, with no issues with the earnings. Also, if you look at this is the sharp correction which has happened. Now what we are looking at was the broader market, but within this market, if you look at, okay, number of stocks which have corrected more than 10%, or 25% or more correction, if you look at about 10%. So the broader indices has corrected far more sharper, or far more, in a bigger manner than what the narrower part has been done. So if you look at from a 150 mid cap indices, so from 101 to 250 is your mid cap stocks in India, almost 100 stocks have corrected more than 10%. Whereas I showed you here, the market's mid caps are positive, say 6%. So what is happening is that the stocks have corrected far more faster than what the indices have done. Similarly, if you look at the small caps, out of 750 stocks, more than close to, I will say, 600 to 620 stocks have corrected more than 10%. So what we
Sure.
are saying is that below the surface, the calm surface, there is an undercurrent where stocks have corrected faster. And that is where we are saying that it's ultimately it is companies which create wealth. So if you get that opportunity to re-enter or do a top up and buy these stocks at
GB
a
sir,
reasonable
one second.
valuation.
GB sir, your screen. Can you please stop screen sharing?
Has my screen stopped being visible? Or?
No, no, GB. Okay, okay. Now it is okay.
Okay. So the point is that you have stocks which have been, again, if you look at what happens is in the market, you will have cycles where certain styles work and certain styles don't work. So just to reiterate, if you remember when you entered Motilal Oswal, we were very clear that our style of investment is more towards growth. Okay, and in the last, like I told you, last 1 year, 1.5 years since Trump has come into presidency, there are a lot of geopolitical events which keep happening, where flight to safety is has become a norm. Okay, and that is where you're seeing that from a 1 year performance perspective, your value as a strategy has worked best. This blue line which you see is value, and this is the momentum, the growth part, where there has been basically underperformance. Will this persist? I don't think so. The moment there is some amount of semblance, and I believe that if earnings are strong, then ultimately earnings will basically make a comeback. Similarly, if you look at that, if growth, the philosophy that we adhere to, if this is just an example, that if you are growing at 16% and if you're growing at 15%, that 1% difference in a compounded format for 10 years, how much will be the return, analysis in the end? So that is what basically this slide is basically trying to tell you, that even a 1% growth rate difference can lead to a 4.5% difference in your return on a compounding basis over a period of time. So growth matters a lot. The higher the growth that you have in your portfolio, the earnings growth, the better is going to be the output. And if you look at, this is the earnings growth of the founder's portfolio that you've invested. So if you look at nowhere, okay, this is the delivered part. Nowhere has the earnings growth dropped. So if you look at quarter on quarter for last 4 quarters, from third quarter of FY25 till the Q2 of this financial year, okay, our earnings growth has been far more superior if you compare to Nifty 500, the broader indices. So everywhere we've almost had earnings growth which has been double. Okay. Again, if you look at the expected earnings growth, we don't foresee the earnings basically dropping. It is just that right now, momentarily, there are a lot of geopolitical events happening where clients have that fear psychosis and they want to basically go towards more of value sort of style. Okay, that's the reason you're seeing this pain, which we believe is temporary in nature. In fact, we are saying that because earnings growth is still solid, it could be a great opportunity to buy great companies which just out of fear have basically corrected. Fundamentally, nothing has changed. So if I were to just show you, this is founders strategy. Look at the PE, how it has corrected. Earnings continue to be stronger, but valuation wise, if you look at from a 71 PE, the current portfolio PE is dropped to 49.2. So if you look at, there's a great drop in the valuations. Earnings is great, and if you look at the P formula is what, price divided by earnings. Okay, the moment earnings, the denominator continues to grow stronger and stronger, and if price is not appreciating, then this strategy is becoming more and more undervalued for you. And if it becomes undervalued, then you will see a lot of contrarian fund managers basically coming and buying. So there are some established contrarian fund managers who this year have given a call for small cap. Okay, they're saying, and for the last 3 to 5 years, they've never said small cap, but now all of a sudden they see value in small cap. It is just because of this, that this earnings growth has not dropped, but the price appreciation has not come. So you're not rewarding the company for what they are delivering. It is just that because of fear, you're doing, and that's the reason this PE is basically dropped by almost 30 to 40%. Even you look at here, the expected earnings growth, and this is across our strategies that we have, whether it is value migration, mid to mega. So you're seeing ultimately the crux is earnings, and earnings has not disappeared in the Indian equity markets, nor has it disappeared from within our portfolio, because we have to construct just a 20 to 30 stock portfolio. Are we actively managing your portfolio? Yes. Wherever we are seeing that the stocks are not doing great, okay, we've exited them. So some exits, if I were to show you, is like Chola, Trent, Kalyan, Samvardhan, Motherson, Inox, Wind, Dixon, Keynes. And since we exited, have those stocks fallen? Yes, the stocks have even further fallen. So we are cognizant to the fact that we need to have an active. That's the reason you guys are with us, whether in the PMS or the AI platform. Okay, we run the same strategy across both the platforms as a concept. So wherever we foresee that earnings is tapering off, or there is some event from a management perspective, we are exiting those. Like Keynes Technology had a event from a management perspective, we immediately exited. After the exit, the stock has even further fallen. So we are actively basically managing, looking at your portfolio. Again, despite strong earnings growth, you will have some amount of correction happening. I just wanted to show you the current portfolio that we are running. Just look at the earnings growth that you have. Okay, so we've added some stocks like Muthoot Finance came in some time back. The pure play that we wanted to do was it was a replicable to the gold rally that you have right now. A lot of people, and Muthoot basically replicates that entire story. So that is basically coming. Engine one we've exited. Grow we continue to hold in a big way, and you can see the earnings growth. So nowhere have we compromised on the earnings growth. Nowhere is the bag, overboard. So if you look at overall, the earnings growth, if you look at, is 48% compared to the benchmark at 16%. And I just showed you some time back that even if there is a gap of 1% in your earnings growth on a compounding factor, the gap of 1% leads to almost 4.5% extra return. Here you have a portfolio which has almost 3x, earnings growth gap. So even if this 48% were to correct by 20, 30%, and this tapers off to say 30%, still you will have an earnings growth which is going to be almost double of what the benchmark is. And that's the reason, if you remember earlier also when you had invested, why we were giving you an earnings growth which was far more superior compared to the market. Okay, and this is what this slide will basically tell you, that whenever growth as a style was working, the alpha was outsized. It is just that this financial year you've had value, or the fear psychosis, and growth as a style, despite having strong earnings growth. So earnings have not gone away anywhere, but just because people want to protect the capital, the style has basically gone out of fashion temporarily, that you have some amount of underperformance basically coming in. But the moment, I think in a quarter's time, that's what we are trading investors, if things fall in place, the geopolitical, I think now even the noise which Trump was making about NATO and all at Davos has started to settle in. You have a Supreme Court judgment in the US to come, where the Supreme Court is going to decide whether the president has power to decide on the tariff. And from the earlier hearing, when just notes were made, uh, it did go against Trump, from the sound or the noise which was made by the before the judgment being delivered. So we're just saying that if these events basically settle in, and that's how markets are, you will see earnings basically coming back. But again, in the long run, uh, our view is that ultimately it is all about earnings growth, and price will always get rewarded based on earnings growth. So you will always have catch up happening. So I don't see that there should be some amount of concern or fear. Honestly, as a fund house, if you ask me, I'll just show you. We also have committed around close to 1,000 crore into founders. Have I exited this? I have not exited. So the way your investors, each of you investors plus are invested into founders, we are saying that our commitment, our skin in the game continues to be as high as 1,000 crore in founder strategy, which should be able to give you confidence that we are not running away. There is some method in the madness that we guys run. Okay, it is not all about madness that we've just picked up high P or anything. The formula is that earnings growth. So this should basically give you a high conviction. And what happens is at times, so if I'm just showing you what is working in the world, so we work into based on themes, and I'll just tell you how it is in a different method. So like you look at our themes are what fast growing NBFs. So on the NBFC side, this is basically the financialization theme that we guys are working on. Capital markets, electronic manufacturing, China one plus new age tech, software, your pharma with GLP-1 molecule, manufacturing is one story. Then you have EV, luxury consumption, defense, and your renewable energy. Just look at how the world performed in these spaces. So if you look at this is just an example of the opportunity size that the theme that we guys are running. So if you look at in the world, you had the EV play, okay, through Tesla, General Motors, how they have performed. Whereas in India, if you look at, it was a combustible part. Even in that, if you look at Mahindra and Mahindra, basically did great because it has a larger EV play. Again, if you look at on the world global, the Magnificent Seven, which is basically the innovation, the tech part. Okay, and if you look at there, how they delivered versus the new age tech companies that you have in India. These are companies which are catering to the digitalization which is happening in India, and how the habits of the local Indian consumer is basically changing. But despite this entire strong earnings growth, still there was some amount of underperformance because they had ran up in a big way. Which is in a growth market, you will always have these dips. That's how the market keeps moving ahead. Similarly, if you look at the way defense has played out in India, we've had 4 years of consistent defense. Globally, defense again played a stellar performance. And you can see Safran as a US based company, how it has performed versus say, Mazgaon Dock in India. We've had one of the best performances, but again, this budget, the idea is that defense outlay will only grow bigger and bigger. So again, there is a huge new market which is forming. Okay, so defense, new age tech companies, these are the new order in India, and in 5 to 10 years, you will see their size becoming very, very big. If I were to just take you back in time, just give you one example and how opportunities crop up without us even realizing. We all use mobiles, right? The handset mobiles. If you go back in time, say in 2005, the entire handset market in India used to be just worth $2 billion. Okay, it wasn't that people will have not loved to own mobiles, and mobile sales could have not been high. It was just that the affordability context, when you looked at in 2005, the affordability was not there because your outgoing charges were very high. Your cost of data was very high at that given point of time. Today, when you look at this cost coming off, the handset market in India has flown off from $2 billion valuation to $50 billion, a 25x growth. And what you see is that leaderships have changed. So in a 2 billion market, you had Nokia being the leader. Today, you have Apple and Samsung being the leader. So what happens is these opportunities, the amount of scale that they get you, and a company which survives that entire cycle really becomes big. So you can look at Apple. Its today market cap globally, because they are just into that handset, mobile, and technology and laptops and everything. The usage of these hardware gadgets has gone up, and they've been able to advance. Look at the market cap that they run at. It's in trillion, right? And that is what we're trying to tell you, that in India also, the order of sectors or say themes is changing. This is an era where digitalization will play a big role. So new tech age companies will become very big. This is an era where defense in India will become a very big play. For the first time, you have a public participation into that. Earlier, if you wanted to play defense, you could not. Financialization will become again a very big theme. So capital markets, asset management companies, will become very big. Okay, so companies which are in that space, because that space itself is going to grow big, will also grow faster. Okay, but when this growth is happening, if there are certain events which leads to fear, then a high growth company could have a stoppage in terms of performance. And this is again, if you look at the way renewable energy is playing, right? Today, just yesterday, there was a news that Europe mein 50% energy now comes from renewable energy. Look at how the renewable stocks globally have done and how the renewable stocks in India have done. Okay. Will India not have a big play on the renewable energy side? We will. But right now, honestly, if you ask me what punctured this entire performance was the tariffs which came in. Wari is one of the biggest exporters in the US. Okay. So you will have certain, but will that space not become big? It will be very, very big. So there is no concern for us on that side. So I'll just show you one more slide and then I will take questions. So, some themes which became very big, and the companies which belong to those themes, how they became bigger. So, if you remember the 90s was a era when, for the first time, IT companies came on board or were on horizon. So, if you remember when Infosys IPO came in 92, okay, it was not fully subscribed. The bankers, the investment banker had to basically subscribe that part. But we know how big Infosys has become. Okay, this is just a data till 2000, till the dot-com bubble, and after that also the growth happened. But was it a straight line? No, it wasn't a straight line. You had spurts when there were doubts on their growth. So the market basically dropped their prices. But the moment the growth was shown that no, it's a consistent thing, you saw the stocks running up. Similarly, if I give you other sectors also, whether it was the two wheeler, when Eicher Motors, the way it performed because of changing income levels in India and people trying to own a Royal Enfield, and Eicher Motor basically progressed on that. Whether it was Pidilite or Trent, per capita incomes going up. When the theme is consistent growth, the stocks which are part of that also multiply for you a big play. Similarly, if you look at say private banks, nobody knew private banks before 2000, right? It was all dominated. Banking was dominated by PSUs. But when the private banks came in, and because that entire India was underpenetrated in terms of banking, and somebody made it convenient for people to open a bank accounts, that advantage was with the private banks. Look at the story that they played out. So right now also we believe the themes that we guys are in, which is urbanization, financialization, make in India, renewable energy and all, the earnings growth continues to be very strong. I don't have any doubt that these spaces will become very very big in the next 1 decade. And when these spaces become very big, the companies which are part of it will also get the benefit because they are going to become bigger. Their pie is going to become bigger. The bucket in which they are operating is becoming bigger. So their share is going to go up. So that consistency of earnings growth will continue. So that's the reason our view at our end is that this is a time when you're getting discounted valuation just because people are having doubts whether this growth is sustainable or not. I will request investors that this is the best time to average, do a top up, enter in the market, buy it when it is available to you discount. Fundamentally, nothing has changed. It is just the fear. So, sentiment, as we say, noise in the short run, which is basically has led to correction of these stocks, not the fundamental earnings growth. So I believe that in the long run, this will end up creating a lot of wealth for you. This is the space to be in. There should be no doubt about it. And as I told you, if there is certain events where there is a management issue, or there is a drop in the profitability, or somebody is innovating and becoming bigger in that space, as a fund manager, as a doctor, we are doing that portfolio churn cut. I showed you certain stocks where we thought the price had ran up ahead of the earnings growth. We cut our positions, and we will reposition ourselves if we have to do. And like I showed you, our skin in the game is as big as you. We are almost 1,000 crore into founders, so there is nothing to worry. My promoters have not exited from founders saying that guys, you guys are not doing a great job. So that is where I will want to stop and take questions if any.
Yeah. So sure. Thank you for giving us a giving reiterating our confidence that
Yeah.
strategy is intact. The companies where we are investing is intact only just because the price correction which is happening due to geopolitical issues. Even
Absolutely.
earnings are intact, and only because of the price correction due to the geopolitical issues. Currently, the portfolio is taking a slight hit, which has delivered superior return in the past, alpha creation in the past, and all of us are beneficiary to it. And you're reassuring that this will continue to give us that kind of a upside going forward with a certain amount of patience added to it. Yeah, that is fairly good. But just yeah, also just to echo what you said, even the traditional fund houses started communicating that invest back to small cap. They're opening up the small cap fund, etc. Some of the AMCs which are traditionally against small cap now voluntarily coming back and saying that to invest into small cap. But then there is one question coming in from people, and there is a chat also. There is one of our esteemed customer has put in saying that people who have joined in 2024-25, they are the one who is seeing red from day one and continues to see red. So how long it will take to revive that position, and what do you expect thereby an extension of this holding period, or what is your suggestion could be? We'll start with that question.
So, so honestly, so people who invested with us, say, supposing in the last financial year, okay, for them, yes, there has been pain because if you remember in the first quarter of 2025, calendar year, we had a sharp drawdown. Okay, and it was because of certain stock where there was a news event, right? Like on Kalyan Jewelers, right? There was a news event and we had built a substantial position. So you saw a sharp drop of 10%, in the month of Jan. But when you looked at in the April, there was also a sharper recovery. So one good part about growth portfolios is that if they see a sharp drawdown just because of certain, news events, when the news basically gets diluted, you also see a sharper recovery which basically comes in. Okay, so it will be a catch up because that was like a pause that because of a news event, the stock because News can only lead to a faster drop, but when the news gets diluted, you also see a sharper rally basically coming in. Right now, like from a global geopolitical perspective, if that basically dilutes, like if you were to look at Indian market per se from a context, uh, in that March quarter, you saw Nifty coming down to 22,000. But if you remember, just 2 months back before the Venezuela event, Nifty had come back to 26,000. So there was a sharp fall and a sharper recovery which came in. Now, as investors, what happens is when there is a drop, there is a fear which begets us, and because of that, what happens is even if we are sitting on cash, instead of looking at it as a buying opportunity, we tend to not buy. Like right now, if I was an investor from FI, in FY 25, and I was invested into Motilal Fund, where I showed you the earnings of my stocks has not gone or disappeared, and the fundamental rule in equity investing is that price is a slave to earnings. Then if because of an event or noise the stocks have corrected, I would rather do a top up and try to average it out and see to it that for the great earnings that the portfolio has, if I'm getting it at a discounted rate, why not go and buy it? Because in the next 3 years, if you have an investment horizon 3 to 4 years, this entire catch up will happen. The moment you foresee that news is settling globally, and market will start running towards earnings growth, you will see these stocks moving up faster, and that is proven historically. So if you look at the performance the way it has been, I can share a month on month breakup also of founders as a strategy, and you'll see that whenever there's been a sharp drop, there's also been a sharp recovery. So I think you will have to slightly stay invested for around 3 years. Good way to continue this journey of 3 years is if you have some cash lying on the sideline, maybe start doing top ups in an STP format of maybe 3 to 6 months, because we see this noise coming to an end in the next 3 to 6 months.
Okay. Then the next question comes in saying that FIIs continue to sell even today. So if India's story is intact and why FIIs continue to sell even in the month of January is what another question comes from our investors.
So see what has happened is, see, for an FI, their returns are all marked to dollar, right? And if you look at our currency, the way the currency has depreciated, okay, in the last say 3 to 4 months, where we've seen a sharp depreciation of around 6%. And if you look at in the last 1 month itself, R has been the worst performing currency globally, around 2.5%. So for them, the return basically gets diluted. And what we've seen is RBI has not been intervening. Okay, and prime reason for RBI not to intervene is basically to provide some support to the exports. What we are foreseeing is that after the tariff, okay, which were basically levied, and if you want to manage, how do you dilute the tariff impact? And that is where you allow your currency to be basically depreciated. Okay, and right now RBI has the leeway. The reason is prime. See, if you look at, we are a net importing country. As a net importing country, for me the biggest concern is if oil starts boiling. Okay, right now oil is not on the boiling side. It is at a reasonable price. If you look at, our central government has never passed on the benefit of lower crude to the end investors, maybe because of whatever they had bonds to be paid or whatever. So we've been consistently getting the same price for oil, what it was when it was at 80 or $90, or what it is basically even at 40 50. That 100 rupees, 110 has been a consistent per liter cost that we've been bearing. Now because of that, government right now is not under pressure to intervene, or RBI is not under pressure to intervene, and because crude is not boiling. So what they're trying is that if they want to dilute the entire impact of tariff to an extent, they are having a free fall of rupee, and the FIs for them, because it is a dollar return. If they were making 10% in India, if the currency depreciation itself takes away 2 to 3%, then they will want to for the timing take a brief pause from coming into the current into the country, and wait for the dollar rupee basically to settle in, and then basically come in. Also what has happened is that from an Indian investor perspective, see, we all invest for tomorrow. In the last 1 year, if you look at for calendar year FY 25, India has been one of the worst performing markets. Okay, so we had the lowest in dollar terms return, around close to 5%. Okay, I think the worst is behind us. And you have a lot of FIs which are basically more like your arbitrage funds, or more like the opportunistic play, where they basically fly off to countries where they have hope of high returns. So I think with underperformance of last 15 months, I think India becomes very attractive for them from a valuation perspective, and that is where we foresee that you could see some amount of FIs coming back once your currency basically settles in. And if you have interest rate cuts happening in the US, which we foresee this calendar year, that the interest rates in the US will continue to basically come off. Yeah.
Okay. So, Mr. Subramaniam, who's joined us from Malaysia, he wanted to ask a question. So, Mr. Subramaniam, sir, why don't you unmute and please raise your concern, sir? Yeah. Can we unmute Mr. Subramaniam? Let me just see. Yeah, Mr. Subramaniam, Jay Guru is the thing asking for unmuting. So, who can unmute? Jason, can you unmute?
Who's the let
Jay
me
Guru, Jay Guru.
yeah, just
Yeah.
why is it not happening?
We can unmute every.
Yeah, we can unmute everyone and then possibly.
Yeah, I'll do that. One second.
Are you the who's the host?
Okay, meanwhile, Subramanian sir, can you just type your questions? I think there is some technical issue coming up
Yeah,
in
it's not. I don't know why is it not getting unmuted.
unmuted. Yeah, can you just type the question and we will read it out? So you asked also the newer space are falls under small or large cap. I'm assuming that the new investment strategy will continue to be there in wherever there is an opportunity. It need not be only small cap because the founder strategy itself, yeah. If you could
Yeah. So
touch
right
upon.
now, if you ask me, the newer spaces are coming more from the mid and small cap. So if I were to just share one slide, I don't know. So I'll just show you the comparison between what the mid cap has and what small caps have. Yeah. So this is your Nifty 50 opportunity bucket if you look at. So when you play the Nifty 50, the large cap bucket, it is more tilted towards like private sector has 25% weightage. Your software and consultancy, the IT, the has around 10 or 14%. Refineries have around 10%. So the large caps typically are tilted towards the traditional businesses, because the Nifty will always have things which are in the momentum and which have become very big. Tomorrow's India or tomorrow's sectors which are emerging typically will be from the mid and small cap, and that is where that entire basically play comes into it.
Meanwhile,
So
Ajit, you have a couple of questions from others, right? Why don't you raise your concern too? Ajit
Yeah.
from our team, yeah.
Yeah, is it audible?
yeah, you're audible.
Yeah,
Yeah, Ajit,
hi.
you're audible.
Yeah. Hi, Hitesh. It is nice, having you talk to our customers, and I think you've done a very good job of explaining how the portfolio worked and what are the dynamics of the portfolio. I'm sure it was helpful for all of us. The main question, I mean, the main concern most of our clients used to, give us a feedback was the fact that uh, they all understand how the markets are during 25, because all of them are quite knowledgeable in the sense of see what is happening around. But the only concern that they used to ask quite frequently is See, while there are other portfolios, be it in the mutual fund or other managed portfolios, be in PMS or alternates, they are able to give a bet. Sometimes, are able to at least uh, give a kind of better returns. While they find that the founders fund over the last 1 year had severely underperformed those benchmarks as well as the peers. So that created a lot of concern. Though you have taken us through it, so that is one of the biggest challenges that we faced trying to convince them. So that
Yeah,
is something we just wanted to just soundboard again for the benefit of the client.
yeah. So see, Jeet, thanks for the question. See, if you look at our portfolios, the way we are positioned, like I told, that we are more of the growth guys, right? And if you compare us, and if you were comparing us, say, with ICICI Prudential, or you were comparing us with Abacus, or say Prashant, or a Boyne, they are more of the value style of management. And in the last 1 year, like I showed you on the slide, it was more value which has worked, in this market right now. Okay, and compared to growth has not been able to work in a big way. Again, if you look at when you do a PMS or an AIF, unlike a mutual fund, which is basically sitting across stocks, right? They will have 100 odd stocks. This is a differentiated portfolio where you pick up 20 to 30 stocks, and you have high conviction on those stocks. So you've given a lot of weightages to those particular stocks or sectors, and at times, what happens is there could be a behavior in the market where your style or your, companies, despite having everything fundamentally right, are not working. Okay, and then that's the reason basically you could be underperforming. So when you pick up our portfolios and you pick up, say, any other place that you've invested, if you compare the portfolio mix, like we always show you this overlap, portfolio, one overlap slide, and you will see that our stocks and the other stocks are totally different. So that's the reason what happens is you could have an underperformance when my style is not functioning. And last 1 year, that has been the main reason. Okay. The style and diversification that you want is where I basically come into play. And our view is that this earnings growth cannot be, diluted for too long. It is just a matter of, a quarter or 2 quarters away where, the style will basically come back. So I don't foresee that we should have any challenging getting back the performance that we guys are looking for. Otherwise, because we are a niche differentiated portfolio compared to others, our 20 picks are different, and those styles right now are not working. That's the reason we've underperformed. And maybe other guys will be hugging the benchmark or closer to the benchmark. If the benchmark has done great, or their tilt is more towards large cap, their portfolio will have actually done far more better. Like if I don't know if you sold the ICC Contra had 75% exposure to large caps. When you look at our founders, we only had around close to less than 20% towards large cap. So you can straight away see the variation that where it is. The question could be that why did you not pick up large caps? Because again, like we said, your investment is a marathon. I don't want to do a sprint run where fundamentally there is nothing great in the large caps for them to consistently perform. Okay, so I don't want to be positioned there. It's okay. In this lap, the large caps have, or the portfolios which have large caps have ran up. But then this was my pit stop on the mid and small cap side, where valuations have unnecessarily eroded despite strong earnings growth. You will have a comeback in a big way once the growth comes in. That's the reason I'm saying this is the best time to do a top up also. You do your averaging cost. This is a time where you collect more units or more shares. That is what I would basically say.
Right. Yeah, rightfully what you said. When the good times, we enjoyed, the entire investors enjoyed the alpha what you have created. So the
Right.
credit comes to you. If you would have followed other AMCs, other strategies, probably you would have been at the same level of alpha at which they would have given it.
Absolutely.
So we are with that. So we are hoping that the strategy will work out as we go and the market settle down, etc. So we
It
have
will.
the
It
full confidence in that.
absolutely. Jimmy, it will. And I'm telling you, you should have a confidence that 1,000 crore we've invested our own money into that. We
Yeah.
have that skin in the game.
Yes,
There's no
absolutely.
regulatory requirement that I have to park that much money.
Yeah. So, Mr. Subramaniam sir, please I think you're unmuted. Can you please speak out?
Hmm.
Sir, you're
I think
unmuted.
I can't.
I
Yeah,
can see
can
you. I can see you unmuted. Can you just speak?
I already tried, but you cannot.
Now your
No,
voice is coming, sir.
your voice is coming. We can hear you. Please
Is
speak
it?
out.
Oh, that will be great. Thank you for that. Hi, Hitesh.
Hi, sir.
Morning. Yeah. My full
Hi,
name
sir.
is Subramanian. I'm not a finance team expert here. Just I'm only layman time. It is actually, for example, I'm the operation manager for one of the organization. Yeah. So I
Right,
have
sir.
some certain target. If I am not deliver, there will be some consequences. Just now we're explaining about the what you call linked item, which is impacting our fund performance. So, what are the actions you guys are going to take to bring back to the fund at least in the FD rate or a little bit higher than the inflation rate? You mentioned the down the road another 3 to 4 years I need to wait. The election is around the corner, another couple of years after next elections for the for the central, yeah. So within 2 years, is it okay to bring my fund to the at least to 10% positive side? At present, it's already in negative 20. Then I need to bring back to normal is 20 plus my inflation another 5 to 10%. So total 30% I need to regain to at least to match my FD rate. Yeah, this is a layman time I'm talking about. I
Sure,
know there are
sure.
you are talking
So,
about the geopolitical issues as well as some the Trump
yeah.
target is target for me, right? So what are the target actually for Hitesh is having? Definitely you have the set of target because you are not handling one Subramanian. You are handling roughly $100 million fund. Yeah.
Yeah, sir.
Yeah, this
Absolutely.
is the seventh series running under his portfolio. So we
Mhm.
should appreciate him for that. And also, Subramanian sir, I mean, just to get Hitesh also on the same pages, he's an investor for the last 9 months. It's the first time from mutual fund moved into
Yeah.
AIF.
Okay. Yeah.
And unfortunately, that year has been pretty bad. So he is afraid that his goal at 3 4 year would not be met if this drawdown continues, if this kind of geopolitical issues continue. This is the question which he wanted to put. And what would be your target, say 3 to 4 years down the line? This is what he's asking. Yeah.
Yeah. So, sir, I understand your concern, but I can assure you that in a 3 to 4 years in this portfolio, you will make returns which will be far more better or superior to inflation. So yesterday also I was speaking to one investor, and it was a US investor, and he was talking about inflation. Say, well, I make more than the 6% return. I can assure you that much that come what may, there is always noise in the market. But the longer the duration that we stay put, and typically in equity we say 2 to 3 years, 3 years sort of a thing, you will end up making returns which will be better off than your inflation. So you have seen a sharp 20% drop right now in your portfolio, but that's what I was saying. We had a similar instance in the month of Jan and Feb 2025, where we saw a sharp fall in our portfolios just because of a noise or a news event with one of the stocks which we are holding, which was Kalyan Jewelers. But the moment that noise settled and nothing came out of it, the entire portfolio had a sharp recovery also. So it is not that we have bought any penny stocks or businesses which are falling apart. These are all strong businesses that you have right now in your portfolio, and just because that certain noise has impacted them more, that's the reason we've seen a sharp drop. But once that settles in, okay, you will see these same stocks pulling off in a big way, because the new era is their era. The new era is their era, and if that new era is their era, then they will have a larger role to play. So these companies will all of a sudden become so big that in 5 to 10 years it'll be like of a different standard. And in that is your journey of say 3 years that you invest. Like, if I just give you a small example, if you looked at India as a GDP, we first hit our 1 trillion in 2007. Okay, it took us almost close to 60 years to get our first trillion, but the next trillion came to us in a period of around close to 10 years. And now we are saying that in the next 10 years From 4 trillion, we'll become, 16 trillion or 4x. So every year I'm going to add, even if I grow at 10%, around, half a trillion each year is my addition, which I'm going to do. So what happens is your compounding becomes faster, and so there is nothing to worry that will this investment give you better return. I can assure you, if your 3 years is your investment goal that you've come for, you will make better return than that. Fundamentally, we have not gone anywhere wrong. It is just that this news event has impacted our companies more, and these companies are part of the new age businesses which are emerging. Their play will become bigger. Hi, sir. So nothing to worry, sir. Not at all. Your retirement is not going to go for a toss for sure.
It is actually it was told by some people. It was advised by some advisor like GP, those who are having very huge knowledge on finance.
Right, sir.
They're like a small bee, like a small potato. कुछ भी बोलो. So we are a small investor. We are not a big bee. Like
No,
actually, we
no,
have
fair,
the
sir.
amount of money, put it somewhere else. I don't bother. Not like that. Actually, this a single penny we are accumulated as a FD and put it and in the AF. So we are not really greedy. Knowledge nahi hai. I'm not talking about 20-30%. At least something better than my FD,
Yeah.
something better than ammo.
So it will, it will.
People talk.
So
Yeah.
it will. That is how equity markets are. So
But we,
just to reassure you, I like showing slides, so I'll just show you one slide.
Sorry. Okay, just quick one, boss.
Yeah, sir.
No, there was some action is ongoing. Is it to make up it? Is it?
Yeah. We've done changes in the portfolio. I don't know if you were there in the starting of the presentation. I did show there were certain stocks which we have exited. So we have exited, we made changes where they were high growth. Like
this,
there was a company
yes.
called Keynes Technologies, if you look at. It's a fantastic electronic manufacturing company. There was some news event on the management because of which the stock took a hit. We exited, just in time, and had we not exited, the stock will have further fallen by around 40%. So we have done that. So we are prudently exiting companies where we don't foresee, value coming in. So we are doing that. That's the reason you've given it to us, right? So as a driver, wherever I have to, apply the entire thing, I'm doing that. So you don't have to worry on that part, sir.
So these are the six worst play we already what do you call
We
it?
moved out of it.
Removed out of. Okay.
Yeah, absolutely.
Okay, got it. Okay, thank you very much.
Yeah. Yeah. Yeah.
So nothing
I,
to worry, So this is what equity markets are. You will have all the ups and downs. So in the stocks, you will always have volatility, but ultimately it'll create wealth for you.
yes. So the one thing which all of us need to realize that FD is a straight line. It
Yeah,
gives you 6%, 6%, 6%. It will not become 5, it will not become 7. While equity market, it will have this ups and down, but it will create a superior return in the longer run. That has been the
absolutely.
history. That will be the future too.
Yeah. So
Ajit,
you will also.
anything more? Yeah,
Yes, please. Sorry. Yeah.
sure. Ajit.
I think most of the questions have been well answered already, and um, I think I'll leave it for any individual questions from the clients. And I'm sure there are good takeaways from this thing. Uh, just one question that I just wanted to know is, do you find any prolongation in the growth strategy, or will it come back faster? Just to get that
Yeah,
particular
possibly,
convenience.
he's asking for the time frame for a
Yeah.
revival from the current situation to possibly to visible, to be visible.
See, I think 6 month is a time period that we guys are foreseeing because a lot of events, a lot of noise. So this quarter you will have. I give you that example of the Supreme Court judgment of the U.S. on tariffs, how it plays out. You'll have the Iran and issue, also clarity basically coming in. You have the budget coming in India. You will also have the U.S. Fed rate cuts basically coming in. Okay, a lot of global countries have already seen the uptick whatever had to happen. Like if you looked at Korea, right, which was the best performing market last year, but when you look at their return, their entire 50% of the Korean returns came from two stocks, okay, which were all AI driven. Like if you looked at similarly Taiwan, one stock contributed to 50% return. So I think you have limitations as to how much can certain concentrated stocks drive you up. Okay, whereas in India, the bucket is far more broader in terms of where you can select. And because we've been the worst performing for the last 18 months. So what say Korea or what other countries are today, we were like that in 2023 after the COVID 2 years bull run. So we've had a fall, and I think now is when things will basically start settling off. So I think the second quarter or the first quarter of FY 27 for India should be great. And I'm saying that this quarter earnings have already started to come off great because the GST cut is straight away reflecting in their broader numbers. So certain places like capital markets and all, 18% GST cut is huge. Okay, in insurance businesses and all, that's like huge cost cut. Okay, so even on the auto side, the numbers are really coming out fantastic. So credit offtake will take off in a big way. Capex has basically started off. So we foresee that fundamentals will take over in the second quarter of this
Alright.
calendar year.
Alright. Anything on generic question on the budget? Do you have any expectations on the budget?
See, honestly, if you ask us, not much because this government once they've come in, budget is more like a non-event sort of a thing. They don't come out so aggressively, though there is a buzz where everybody is trying to build a case that capital gains should basically be cut or whatever to attract FIs and all. So it's a guesswork, but honestly, now budget has become a non event. It's just a one-day event where the markets react. This government has been making policies across the calendar year. They don't wait for the budget or a specific day to come out with a particular policy. Like when GST cut they wanted to do, they just did it in they didn't wait for a day. So that's a great part of about the government, that they don't surprise you too much. If they have to do it, they'll do it. During the normal
At the
course of
appropriate time.
business.
All right. Got it. Yeah. I think then if we don't have any questions, we can wind up the session because it is a Saturday. Again, Hitesh has agreed to come in and talk
No,
to all of
no,
us.
not at all. Yeah.
It's been so thankful to you, Hitesh,
No, not at all,
and
GB.
Nitin and Jason for arranging this, that too on a short notice. So thank you, and we will definitely take the learnings to many of the investors who couldn't join today due to some their preoccupancies. But we will have to send a note to all of them, and we will do that. And wherever slides can be shared, Hitesh, we would be happy to get some of the shares which you have mentioned about the change in portfolio, etc. And yeah, and we will share it with them. So thank you once again, Hitesh, for joining with your insights, and Nitin, Jason for arranging this and being support always. And we will continue to strengthen our association between Motilal Oswal and Trinity.
Thank you,
Sure.
sir.
So
Thank you very much. Thanks everyone for
thank
your
you, all
thanks
of
for
you.
time.
Yeah.
Thank you so much.
Any
Thank you,
other help
Hitesh.
you
Thank
need,
you.
let us know, GB. We'll
Sure,
connect with the clients who have not
sure.
been able to join today.
Yeah.
Nitin and Jason,
So
and we
there
will
could be
connect.
one family office which we would want to get them
Sure.
connected
Just let us know next
separately at
week.
your
Yeah,
convenience. Sure.
absolutely. Thank you
Thank
very
Thank
you.
you.
much.
Thank
Yeah.
you again.
Have a
Thanks,
nice
Hitesh.
day,
Bye
sir.
bye.
Thank you, sir.
Thank you so much. Thank you.